Hello, and welcome to the Investors Roundtable, a four-way discussion where Roland Head, Mark Simpson, Graham Neary, and Maynard Paton talk about their shares, portfolios, and the markets. Roland likes reliable dividends, Mark prefers deep value, Graham seeks quality compounders, while I look for owner management. Let's get started.
Hi, everyone. Good to see you.
And you, Mark?
Nice to see you.
How's everyone doing?
Yeah, fine, thanks. How are you?
Hi, Graham. I think people have realised by now that with Bruce on sabbatical, you've stepped in to join us on the Investors Roundtable. So we have been asked a question about mistakes. So I think a lot of people talk about stocks have done well, great decisions they made, whereas the real learning comes from those times we make mistakes and we learn from them and we adapt our practices. So, Maynard, have you got a mistake you'd like to share with us and what you learned from that?
Yes, I've narrowed it down. So this is Tasty. This is a restaurant chain. Bought at 50 pence in 2011, bought some more at 109, averaged down at 45, and again at 15, and sold for 2p earlier on this year. So I did sell some at 179 near the top. I'm down only 85% and would have been down 96 had I not sold any. So what became a disaster. The family management, he created multi-bagger restaurant chains before. So Ask Central in the 90s, Prezzo in the noughties, they were both 5-baggers. And I thought Tasty would be another multi-bagger. But the economic of restaurant chains deteriorated. So perhaps due to greater competition, but due to structural changes in the employee market and employee costs. So Tasty employs lots of low-paid part-time employees, and the minimum wage payments rose faster than revenue. So when I bought, staff costs were 36% of revenue, and last year they were 44% of revenue. So the margin was squeezed, and other costs as well increased as well, but it's mostly employee costs. So what was the 10% margin went to less than zero. And the big problem was the national living wage. So that was introduced in 2015 and £6.50 an hour, and that's up 60% since then, and that's turbocharged minimum wage payments. The customers were not prepared to pay higher menu prices to cover the higher employee wages. We're not prepared to pay 60% more for their pizzas. And the low-paid workers didn't work 60% harder for their extra wages. It was a complete disaster. And I now avoid companies that employ low-paid, low-revenue earning staff, because generally I think they are low quality businesses where the major cost, which is staff, that's set by the government and not market forces. So there's lots of other lessons as well in there, because it was a complete disaster. But that's the main one I thought, which was new to me, was looking for structural changes harming a sector, and also costs that are set by the government and not the industry and market forces.
Yeah, that's a really good one. And two things I wouldn't have naturally thought to look for as well. So it's really good to have that slightly different perspective on risk factors and things that might go wrong. Graham, have you got an example of something that's gone wrong?
We've got plenty of options here. We've got the insolvency one, we've got the value trap, and we've got the fraud. I think I'll go for the value trap. I haven't talked about that one in a while. The value trap that was my favorite stock for a while was North Amber, a very old name. And actually, it was one of the best experiences because I got to know, I won't name their names, but I got to know some other investors by going to the AGMs of the company. I don't go to many AGMs at all, but I felt it was worth going to that one. North Amber, this is a few years ago now. This is at least 6 years ago now. But essentially, it's a distributor, a tech distributor, and its ticker is NAR. It's a kind of a dying breed of company, and for good reason. The company hasn't made a real profit in donkey's years, but I suppose while I didn't make any money out of North Amber, I did gain a lot from the relationships, meeting with fellow suffering shareholders at the AGMs every year. And I also learned a lot about value traps. So there's a majority shareholder here, and very sadly, the founder of the business died a few years ago. His son is now the managing director, and he has a 63% stake in the business. So I suppose the great learning there was about family businesses. If you're trying to convince somebody to do something that they don't want to do, you're just going to fail. And that's what we did at the AGM every year. We said, look at your balance sheet. Your assets are not earning an economic return. And they didn't care. And they're still at it now. They're still going. They had an interim report. The most recent interim report showed EBITDA loss. They have net assets of £24 million and a market cap of £12 million. The assets are real, could be liquidated, but they're not going to be. I learned that letting your money waste away in these things for years there's a terrible opportunity cost. You could be investing in almost anything else and be compounding positively. Instead, you just get stuck in these value traps and your money just wastes away doing nothing. So that's my mistake. I've learned from it and I shall not be doing it again.
I think these kind of handovers to family members can go both ways, can't they? They can go a new set of eyes who reinvigorate the business and make changes, but also you can get somebody where they want to maintain their family member's legacy in the way that they wanted it to be managed. And actually, they're very highly resistant to change, perhaps even more so than the original family member. Yeah, I think that's a good warning. And perhaps one where actually you learned that by going to the AGM. Maybe you'd learn that after 10 years of holding this and it going nowhere, but the fact that you spoke to them and they just didn't listen is perhaps the
the day I finally got rid of North Amber for the last time from my portfolio was an AGM day, and I was in a cafe near the company about an hour after the meeting, and I just got rid of them all on my phone, and that was it.
You're probably lucky to get the liquidity. Maybe AGM day is the only day you get the liquidity on that sort of stock. Right, Roland, any mistakes you're willing to share with us?
Yeah, there's always a few, but I think one of the things that comes to mind, really, Graham talking about value traps, and then a few minutes ago we were talking about Morgan Advanced Materials and how the business doesn't seem to have created any shareholder value for a long time beyond the dividend. And I think that's really what comes to mind for me, is that when I started investing, and for quite a few years, really not understanding the difference between price and value and focusing more on valuation rather than trying to understand whether a company was creating value for its shareholders. And for a short-term trade, then that isn't necessarily the most important factor. Shares can re-rate and other things happen. But if you want to hold things for a long time, then one of the lesson I was maybe slow to learn is that you have to own something that actually is sustainably creating additional value for its shareholders over the years. It's easy with hindsight when you look at something, but an example for me then is that in 2015, I bought some shares in Diageo, the drinks group, for about £19, I think. And so obviously that was always generally seen as a good quality stock. It's highly profitable. It generates plenty of cash, has lots of good brands, and it's not a perfect business, but fundamentally it is a high return business. And as far as anyone can see, it is sustainable and should continue to create value. And so if I'd done nothing since 2015 and I still had those shares, I think I would have got a total return of something like 9% a year since then, with really very little risk and certainly no sleepless nights. But instead of sticking with it, I fixated on the fact that the PE was high, the dividend yield was low, and maybe there were better opportunities. And so I sold them, I think, at about £22. And then I think I bought something that looked cheap, but was inevitably lower quality. I think possibly it might have been shares in Vodafone at the time. Now, Vodafone is a business that is a classic example of something that hasn't created value. In fact, probably destroyed quite a lot of shareholder value. For me, that's really been the lesson, is to understand how a business, or if a business is creating value, and look at it through that lens, not just in terms of its immediate valuation.
Great. If that was your worst mistake, I'm going to blow that out of the water now. So the one that comes to mind, and I actually write about this in my book, is a massive level of overconfidence that I had way back when in 2007. So I invested in a company called Toledo Mining, who had a nickel mine, and they were pretty effective at getting it into production. They started with what's called a direct shipping operation. So they take the top layer of soil off and they dig up the ore and they ship it off to China, and they were highly profitable for about 6 months to a year. And the share price went from £1 to £5, and I started to think I was an investing genius, as we do. Did lots of work on this company. I understood, how it worked, what their plans were. I'd attended the presentations. I'd not met management, but I knew a lot of detail, and I had to my detriment, actually, a discount cash flow model of how much money this company was going to make from their direct shipping and how that was going to be reinvested into developing a proper mine and more value-added aspects of nickel mining. What I didn't realize was the Chinese consumers of nickel wanted this product, this nickel ore, when the price was high. And as soon as the price dropped below a certain level, it wasn't like, oh, we want half the amount of ore. It was, we don't want any of this ore at all. So it went from being highly profitable for them to being completely uneconomic. So when that nickel price dropped, as it did with the general market in 2008, the demand for this product went from high to absolute zero. And of course, the company didn't have anything left. And to my detriment, I didn't sell a single one of these shares because my discount cash flow model said that it was worth £20 or £30 or whatever it was. And I think maybe I sold or no, I think it got to the bottom of about 7p in the financial crisis. So I'd taken this from £1 up to £5 down to 7p. And to make matters worse, at the time at its peak, it was 50% of my portfolio. Now, thankfully, I didn't have a lot of money invested then. So the actual monetary amounts are relatively minor compared to my portfolio today. But in terms of, if you consider the compounding, if you take 50% of your portfolio 1 year and just write it off, that destroys your compound annual return. That capital is not coming back. And thankfully, I was earning at the time and I could put fresh capital in and I could add to my ISA. It wasn't terminal, but it really focused my mind on to try and be overconfident, not to believe that if I've got a DCF of it, that DCF is not reality. And secondly, I really try and limit the amount I will have in any one position now, because that overconfidence of I have a big position in something because I believe in it and it collapses, it really isn't for me. The idea of a 50% loss on my portfolio today would be more severe for me than it is then. As I hopefully compound and grow my portfolio, I want to become less concentrated and more diversified. Hopefully a lesson for everybody as well, or for some listeners.
Did you eventually get rid of Toledo?
I think they were taken over in the end for maybe about 40 or 50p or something. And probably if I hadn't taken such a big position loss, I would average down, would have behaved more rationally. But there's something about that size of loss that means you end up deer in the headlights, as the common thing is. Anyway, that question was from Dinesh. So thanks, Dinesh, for that. I think that's interesting topics and some interesting learning points for us all. So yeah, that's it for another Investors Roundtable. Hope you enjoyed it. And yeah, thank you for joining us. And I enjoyed that. That was great fun, guys.
Well, that's it for this time. Once again, thank you for supporting our podcasts. And until next time, happy investing and goodbye.